In this presentation, we will take a look at the itemized deduction related to interest, which would be reported on the Schedule A. We're going to be concentrating down here in the itemized deductions with our income tax equation. Remember, the top half of the 10 income tax equation is basically an income statement. We start off with income or revenue minus the above the line or Schedule 1 or adjustments for income, giving us that subtotal of AGI, adjusted gross income. Then we take the larger of the standard deduction or itemized deduction. We here focusing in on the itemized deduction. So we would be using these itemized expenses only if in aggregate the itemized expenses would be adding up to greater than the standard deduction. We're concentrating here on line 9, which is the standard deduction or itemized deduction. We of course concentrating on the itemized deduction, which would have to clear these standards in order for the itemized deductions to be taken. The itemized deduction we will be focusing in on Form Schedule A is the interest you paid itemized deduction. Now, just when we think about that interest you paid can be a bit deceiving because obviously most interest or a lot of interest, most interest that you pay is not something that you can deduct if it's going to be personal type of interest. So only certain types of interest can be deducted. The main thing that we're going to be considering for many individuals is going to be the interest related to the home. So the home mortgage interest is going to be a crucial component. It's also one of the biggest components that push people over from the standpoint of taking a standard deduction to itemizing. So if you're doing tax returns and someone owns their home, they probably have a mortgage on the home, that's when you really are going to say, okay, it's quite likely that this person then would be pushed over for itemized deductions due to the mortgage interest and due probably to the property taxes on the home as well. For more information and research about individual instances, you want to go to the instructions for Schedule A. We will include those instructions here, and you can find them at the IRS website at irs.gov. Interest you paid. The rules for deducting interest vary depending on whether the loan proceeds are used for business, personal, or investment activities. So when you think about interest you're paying, then you want to break it out into those three categories. Now, when you think about those three categories, note that the normal rule for expenses or deductions are generally thought of as things that are going to be business deductions. In other words, the things that you would think would be deductible are those items that you had to expend in order to generate revenue. That just makes sense from an income tax purpose. In other words, if I made $100,000, but I had to spend $60,000 in order to generate the $100,000, it wouldn't make sense to tax me on $100,000. You can only tax me on the $40,000. That would make sense because I had to pay the $60,000 in order to generate the $100,000. Those are going to be normal business type of expenses, things we had to expend in order to generate revenue, and therefore you would think them to be deductible type of items. The personal items you would think not to be deductible as a general rule. So if I had an expense of going to Disneyland or something like that, that typically would not be deductible because I didn't need to spend that in order to generate the revenue. That's going to be a personal expense. When you think about the interest, it's a similar kind of situation. If you have a business and you had to take a loan in order to help you to generate revenue, to put capital into the business, then you would think that would be a legitimate expense and therefore something that would be deductible, but usually deductible on something like a Schedule C if it's your personal business, as opposed to Schedule A itemized deductions. So that's kind of like the general rule. Now, the mortgage interest is a bit of an exception to that. So we have the mortgage interest there on the home, which you would think is not business use. You'd think it'd be a personal use for the most part because it's going to be a personal home unless you work in it, at which time you might put part of that interest on the Schedule C for the business related portion of the interest that's being paid on it. So you can think of the mortgage interest as kind of a deviation from that general rule, and we're going to have to put in what kind of restrictions would be involved given the fact that it's kind of a deviation from that general rule. Now, why would it be a deviation? It might help to think through and think about, well, why would that kind of personal item be a deviation? It may be that the law, it was trying to incentivize housing. So if they're trying to incentivize people to be able to own housing, then one way they do it is they might try to make the interest on the mortgage deductible. That could be one justification. Now, I'm not sure that's effective. The end result of that may be the inflation of the housing price, the original cost. I'm not sure about that, but that's going to be one reason that you might say that the federal law has the interest that would be deductible. So just knowing that might make it a little bit easier to see that as an exception. So you want to see the general rules and then kind of see where the exceptions are, and if you have the reasoning as to why there might be an exception, might be easier to understand. So we can see publication 535 for more information about deducting business interest expense. See publication 550 for more information about deducting investment interest expenses. You can find those on the IRS website, irs.gov. You can't deduct personal interest. However, so again, if you had an interest on like your car or something like that, and it's your personal vehicle, typically you can't deduct the interest on the car if it's a personal use car, whereas the mortgage interest you may be able to deduct. However, you can deduct qualified home mortgage interest on Schedule A and interest on certain student loans. So student loans is the other item that you can think about possibly having a deduction on the interest related to student loans. That would be on Schedule 1, Form 1040, 1040 SR, line 20. Now, the justification for student loans is similar to that for possibly justification for housing in terms of why would the law be that way. A student loan you would think would be personal. You could argue that it was a business expense because you're going to get the job in the future, but it's really kind of a self-improvement expense at the time you're doing it, and therefore you'd think it would be personal. The government's justification or justification for student loan interest being deductible would typically be that, you know, trying to incentivize more education. And again, it's an argument as to whether that's effective or not, because it could be the result happening that the cost of education just goes way up due to it being a form of subsidy. So you can think about whether it's a good thing or not, or whether it's working from an economic standpoint to do that, but that's probably the justification for student loan interest being deductible. And if you use the proceeds of a loan for more than one purpose, for personal and business, you must allocate the interest on the loan to each use. So you really want to try to keep everything different, as separate as possible. This is a business loan, this is a personal loan. Because then it'll be easier to think about whether the interest will be deductible or not. If you can't do that, if you have one loan that has been spent on business and personal, then you have to prorate it in some way to figure out the deductible portion. You allocate interest on a loan in the same way as the loan is allocated. You do this by tracing disbursements of the debt proceeds to specific uses. For more information on allocating interest, you can see publication 535. In general, if you paid interest in 2019 that applies to any period after 2019, you can deduct only amounts that apply to 2019. So this is an issue where people would try to basically have a timing issue on their loan. What if they try to really prepay the interest? In other words, they haven't incurred the interest because interest is kind of like rent. Like if you were to rent a building and you'd get to deduct the rent if it was a business building, you might try to say, hey, well, why don't I just pay 5 years worth of rent today and get a big deduction today and get the deduction now, as opposed to in the future time value of money that would usually be beneficial. You can think of someone doing the same thing with interest. Well, I'm not going to pay the rent on the money, the interest on the money, the use of the money in the future. I'm going to pay it all right now and then deduct it right now. Well, you can't really do that because you haven't incurred the interest. It's going to be the general rule. If you are a homeowner who received assistance under the State Housing Finance Agency Hardest Hit Fund program or an emergency homeowners loan program, see publication 530 for the amount you can deduct on line 8A or 8B. Moving on to the home mortgage interest. A home mortgage is any loan that is secured by your main home or second home, regardless of how the loan is labeled. It includes first and second mortgages, home equity loans, and refinanced mortgages. So just to get an idea of the mortgage, note that some people have a kind of a misconception on what the mortgage means. Like you'll hear people say that the bank owns part of your house, and that's usually just kind of a phrase, but that's not exactly how you want to think of the mortgage typically. You want to think of the mortgage as, if you're purchasing the house and the house costs $100,000, you purchased the house, you own the house. However, you had to get a loan in order to purchase the house. Let's say the loan was for $40,000. So now you've got a loan. So you have the asset on the books at $100,000, the loan's at $40,000. So the bank doesn't own 40% of the home because they don't have any say as to how you use the home. You can do whatever you want. You don't have to consult the bank. The home is the homeowner's. However, the bank is owed money, and in order to secure that money, they're going to use the home as basically collateral on the loan. Therefore, as long as you're good on the loan, then you can do whatever you want with the home and the bank has no say. You own the home. However, if you default on the loan, then the bank would then have recourse. So the home is basically securing the loan. Now, and that's usually when you would think, well, that could be a situation where the interest on the loan could be deductible. Now, there's going to be some limitations on that as well, because you could imagine a situation usually when there's a loan on the home, a mortgage on the home, it's at the purchase of the home. So if we bought the home for $100,000 and then we took a loan out in order to purchase it, or even a first and second loan out, the reason to get those is in order to purchase the home. And we can also think of a refinance situation where you're going to refinance to get better terms on the loans in a similar type of situation. And we can also think of a situation where you're taking out a new loan after you already own the home. However, you're doing that to put improvements on the home. You're going to invest the money that you took out and you use the home as collateral on in order to put a second story on it or something like that. Or you can think of a situation where you take out money from the home, or you take out a loan, you use the home as collateral, and then you use the money to go on vacation, which is kind of a different situation. Now you're taking out a loan and it has no connection to the use of the money in the home, even though you're using the home as collateral. So if I took out a $100,000 loan, I go on vacation with it, and I still put the home as collateral on that loan. So if I don't pay back the loan, the home is still collateral, but I didn't really need that money in order to purchase the home, right? I got that money, used the home as collateral in order to go do something else. So those are kind of the ways you want to think of the loan. Most of the time it's in the purchase or a refinance type of situation or an improvement type of situation. But you can also think of a situation where the home is collateral and it's used for some other purpose. Those differences and those distinctions could have an impact on the deductibility of the interest related to the home mortgage. So a home can be a house, condominium, cooperative, mobile home, boat, or similar property. It must provide basic living accommodations, including sleeping space, toilet, and cooking facilities. Limits on the home mortgage interest. Your deduction for home mortgage interest is subject to a number of limitations. If one or more of the following limits applies, you can see Publication 936 to figure your deduction. Publication 936 can be found on the IRS website. Limit for loan proceeds not used to buy, build, or substantially improve your home. So think about this situation. You already have a home. The home has gone up in value, meaning you have equity in it. You have the value of the home is greater than the loan by a substantial amount, and therefore you want to take money out on it and go on vacation or buy a car or go back to school or do something like that, something not related to the home at all. You can probably get a loan if you use the home as collateral because the bank feels it's a fairly secure loan, even though you're not using the money that you took out in order to improve the home or buy the home or anything like that. You're using it to go on vacation or buy a car. So in that situation, that's the situation we're talking about here. You can only deduct home mortgage interest to the extent that the loan proceeds from your home mortgage are used to buy, build, or substantially improve the home securing the loan. So that's going to be qualified debt. Make sure to check the box on line 8 if you had one or more home mortgages in 2019 with an outstanding balance and you didn't use all the loan proceeds to buy, build, or substantially improve the home. The only exception to this limit is for loans taken out on or before October 13th, 1987. The loan proceeds for these loans are treated as having been used to buy, build, or substantially improve the home. See Publication 936 for more information about loans taken out on or before October 13th, 1987. See Publication 936 to figure your deduction if you must check box on line 8. Limits on home mortgage interest. Now notice there has been a change, so we're going to have the cutoff date, and we're going to take a look at the change before the cutoff date or the law before the cutoff date and after the cutoff date here. So for qualified debt taken out on or before December 15th, 2017, you can only deduct mortgage interest up to $1 million or $500,000 if you are married filing separately of that debt. So that's a fairly high amount right there, because notice what we're talking about here. This isn't the actual loan we're taking out. If you purchased a home, If you purchased a home, whatever the home price was, then you would take the loan out on it, which you would think would be less than the actual purchase price of the house. And then we're talking about the interest being paid on that loan being less than $1 million. So that's a pretty high limit. No, most individuals aren't taking out a loan on a home where the interest is going to be over $1 million. I mean, to be honest, that seems almost absurdly high of an amount, because you would think that the law to allow you to deduct the mortgage interest would be to help people to purchase a home. And to have the deduction that high, to go up for that high of mortgage interest, you would think wouldn't be helping the normal individuals. So continuing on, the only exception for loans taken out on or before October 13th, 1987. See publication 936 for more information about loans taken out on or before October 13th, 1987. See publication 936 to figure your deduction if you have loans taken out on or before December 15th, 2017 that exceeds $1,500,000 if you are married filing separate. Then we have the limit on loans taken out after December 15th, 2017. So here's going to be the changes. Now we're after the cutoff date. Remember, anytime we have, or a lot of the times when we have these laws that change, we have to think about they can't really go retroactively and go back in time. So you got to think about the law before the cutoff and then the law after the cutoff. So here we have after the cutoff. For qualified debt taken out after December 15th, 2017, you can only deduct home mortgage interest up to $750,000, $375,000 if you are married filing separately of that debt. So again, they cut the limit down, which probably kind of again makes sense, because usually the qualification for the home mortgage interest would be that it's helping people to purchase a home that possibly may not otherwise be able to do that. And this is still a pretty high limit, because we're not talking about the actual purchase price of the home here. We're not talking about the loan amount here. We're talking about the interest on the loan in a year's time period. So that's still, a pretty high dollar amount of interest. However, if you also have qualifying debt subject to the $1 million limitation discussed under limit on loans taken out on or before December 15, 2017 earlier, the $750,000 limit for debt taken out after December 15, 2017 is reduced by the amount of your qualifying debt subject to the $1 million limit. An exception exists for certain loans taken out after December 15, 2017 but before April 1st, 2018. If the exception applies, your loan may be treated in the same manner as a loan taken out on or before December 15th, 2017. You can see publication 936 for more information about this exception. See publication 936 to figure your deduction if you have loans taken out after October 13th, 1987 that exceed $750,000 or $375,000 if you are married filing separately. Points not reported on Form 1098. So typically when you have mortgage interest, you'll usually get a 1098, and the 1098 will be fairly straightforward. It'll provide you the mortgage interest that you're going to typically be putting into your tax software to take the deduction for the mortgage interest. However, there could be situations where we have points which may not be reported on the Form 1098. Points are shown on your settlement statement. So this is often the case where if you had a purchase that happened that year, so if you have a mortgage interest, it might have been a home that was purchased in prior years and you're paying mortgage interest, and you'll get a Form 1098 on it typically. However, if you have the purchase in the current year, then you might want to you should go through the settlement statement, the closing statement of the purchase, to figure things like points, which you may be able to have a deduction for. So points are paid only to borrow money. Money are generally deducted over the life of the loan. See publication 936 to figure the amount you can deduct. Points paid for other purposes, such as for lender's service, aren't deductible. Refinancing. Generally, you must deduct points you paid to refinance a mortgage over the life of the loan. This is true even if the new mortgage is secured by the main loan. If you use part of the proceeds to improve your main home, you may be able to deduct the part of the points related to the improvement in the year paid. You can see publication 936 for more details here. Investment interest. Investment interest is interest paid on money you borrowed that is allocated to property held for investment. It doesn't include any interest allocated to passive activities or to securities that generate tax-exempt interest. Here's an example of a Form 1098 mortgage interest statement. So this would typically be what you would be receiving if you had mortgage interest that was paid. This will help you to put the data input into the software into your tax return. There are instructions as well. These will have a line-by-line instructions that you can find on the IRS website. We'll also include them as well, so you can take a look at the instructions. Remember that the form of these, or the look of them, the shape and feel of them, may differ, but the boxes will be lined out. So if it says a 1098, it's mortgage interest, it's going to show you the numbers of the boxes, and those numbers of the boxes will line up to the instructions that you can find on the IRS website at irs.gov.